Welcome to the CC&A Insurance podcast. I am your host, Laura Aliphon, and in each episode, we sit down and with our experts to simplify the world of insurance and risk management. Our goal is to provide you with practical information you need to protect what matters most to you. Today, we are diving into the topic of body corporates. Joining me to share her expertise is Abigale Dixon, who serves as a broker assistant at CC&A Insurance Brokers. Welcome, Abby.
Hi, Laura. Thanks for having me.
So, Abby, can you tell us a bit about body corporates? What is the responsibility of the body corporate, and what is the responsibility in terms of insurance for the owners of the properties?
Okay, so the body corporate insurance mainly just covers the structure itself, the common property, and any permanent fixtures that would have been part of the original build. Additional sums insured for improvements or additions that owners have made would be the responsibility of the unit owners to make sure that that is included on the body corporate's policy. And then the unit owner's responsibility would be things like their own contents. They would need to cover that on their personal insurance. And then any exclusions that may be as a result of wear and tear or lack of maintenance would likely then fall on the unit owner unless it forms part of the common property, which would then still be the body corporate's responsibility.
Do you get a lot of questions like this?
I do sometimes. I think there is a little bit of confusion between what is actually covered by the body corporate policy. And there have been quite a few times where I've spoken to clients where they don't realize that the contents is their own responsibility to insure.
And additional cover? What additional products are there available that maybe people don't know about?
So the specialized body corporate policies or products that we have available are generally quite broad and cover most aspects. So that would include your public liability if somebody had to injure themselves or die on the common property. And that's a mandatory cover at least for a limit of 10 million. So that's probably why it's automatically part of the product. Then you've got the Trustees Liability, which is also a mandatory cover. It protects the trustees from being held liable for decisions that they make in good faith for the body corporate. Then you have Fidelity Guarantee. So that covers loss of money due to fraud by trustees, employees, or managing agents. That's also normally automatically included between 50 and 100,000, but additional cover can be taken up separately or on the main policy. But a proposal form is needed to be filled in because of the details regarding how funds are managed, if there's multi-factor authentication or sign-off. One product that can be quite beneficial to take standalone, geysers are covered on the policy, but there is a product that will either waive the excess or provide geyser replacement cover on its own. This helps keep the loss ratios down on the body corporate because a lot of the time the most frequent claims are the geyser claims. So taking out a separate policy would protect the overall policy's loss ratio to an extent. There's also limited cover for things like maintenance or having to move the geyser due to compliance. Yeah, those are the most notable additional covers or products available in the market.
And valuations for sums insured, can you chat a little bit on that? I understand that it is a requirement for body corporates.
Yeah, so a body corporate is required to get a professional valuation done at least every 3 years to make sure that the replacement value is correct or adequate. And this should include rebuilding costs, professional architectural fees, and demolition and clearing costs. A lot of people mistake the replacement value for market value, which is very different. Sometimes you can see that the difference is about half or even less than that.
Because there's other factors to consider.
Yeah, so
to replace.
it's not buying it, it's rebuilding and everything else that goes with it.
So it's your architectural fees, that sort of thing.
And then in between, when the body corporate gets the professional valuation done, it's the responsibility of the trustees to make sure that inflationary increases are adequate. So when we process renewals, we do apply an inflationary increase, but we don't have much say in terms of if it's accurate or not. So that falls on the body corporate to make sure that that's correct. I've had a few queries from clients. This one policy, it was 2 units, and the one person wanted to not apply an increase that 1 year, and the other person wanted to keep the increase. But in those cases, either both increase or both stay the same. So the increase is either applied overall or not at all. And in terms of premium increases, we get queried a lot on that as well, because it is understandable that people are watching how much things cost and why is the cost factor rising. So when we process the renewals, obviously the inflationary increase forms part of the premium increase, but other factors do come in. So depending on a client's claims history, we would then apply a rate increase. And I've also had queries whether we are able to apply that increase to just the unit owners that have had claims. But unfortunately, at an insurance level, we are unable to do that, because it needs to be part of an agreement between the trustees that is how they want to handle it, instead of having the premium increase across the board and everybody feels it. They would need to determine in an AGM on documented time that it needs to be split across the unit owners who have had claims.
So it's mainly because of claims.
Yeah.
That they would want specific unit owners to have a higher increase at renewal.
Yeah. So that forms part of the body corporate's responsibilities, because they need to have a meeting and decide on that, and then decide how they're going to process that increase. Because I mean, if somebody has an 8,000 Rand claim and somebody else has a 2,000 Rand claim, how do you split that? And then from an insurance perspective, how do you maintain that? So this year you apply 80% of the premium increase to this person because of their 8,000 Rand claim, and 20% to the other body corporate owner. What would you do next year? Reversing it or trying to apply those increases? It would be so hard to keep track of. But yeah, according to legislation, we are unable to make those decisions.
So the insurer would look at the policy as a whole.
Yes.
And look at the loss ratio of the client.
Yeah.
Being the body corporate.
Yes.
Not the individual owners.
Yeah. And I think that stems back to the general idea of insurance. Everybody pays for the few that claim. Otherwise, it wouldn't be a profitable business, or it wouldn't work. We wouldn't be able to get insurance anymore.
So, Abby, do you have any examples of where cover was insufficient or a claim was rejected that you think might benefit our viewers?
So I think one of the most interesting ones that I've had in the last couple of months was the client had started changing the garages to become a place of worship. And from what we could tell, we actually weren't even sure if he had registered it with the government as a place of worship, because it's up to a different standard or code for their regulations, building regulations. I think there was a leak in the roof, and he got somebody in to fix it temporarily. And they had put the plastic covering on top with the bricks, and then there was a big storm and the whole roof collapsed. So when the assessor went out and had a look, the slope of the roof was incorrect. So it was built wrong altogether, whether it was still a residential property or up to the place of worship or place of gathering standards. The insurer rejected the claim on the basis that it was not up to code, But the fact that there was non-disclosure in terms of what the part of the building was used for also would play a factor in deciding whether the claim gets paid or not, because that completely changes the risk. So body corporates are insured, or at least this one is specifically insured for residential use only. You can cover body corporates that are commercial use, like your malls. I don't think that would really form part of that, but like your share blocks, your office blocks, that kind of thing. But they're specifically noted as being for commercial use. So they're rated differently in terms of what you charge in premium, and there would be different aspects of cover that you would look at in that case.
So, Abby, if this client had disclosed that they were using the premises for non-residential purposes, what impact would that have had on the premium versus what they've lost now with the claim being rejected?
So it probably would have worked out better if they had disclosed it and the insurer had agreed to cover that section for non-residential use. It would have to be referred to insurers to see what the premium increase would be. And they would probably also look at it in terms of it not being used for residential and as a place of worship. And they might apply specific excesses or exclusions or give suggestions as to where to increase cover in other aspects. But I mean, I think maybe an extra R1,000 a month, if that were the case, would probably be better off than R100,000 claim not being paid.
Well, thank you, Abby, for joining us today.
Thank you for having me.
That brings us to the end of today's conversation. For those listening at home or at the office, we hope that you found this discussion valuable. If you have any questions about the topic we've discussed today and you'd like to review your insurance portfolio, please reach out to the team at CC&A. You can use one of the links either at the top or the bottom of this video, and you can get in touch with us. Thank you for joining us on the CC&A Insurance podcast, and we look forward to seeing you in our next episode.